Imagine a company finally throwing open its doors to the public, inviting everyone to own a piece of its future and growth. That's an initial public offering, or IPO, in a nutshell. It's a significant milestone in a company's journey. It's when a privately held company decides to sell shares of itself on the stock market for the very first time, transitioning from private to public ownership. Why do companies do this? Well, it's a great way to raise money for expansion, pay off debts, or even let early investors cash out their investments. For everyday investors like you and me, IPOs offer a chance to get in on the ground floor of potentially exciting companies with promising futures. But remember, just because a company is going public doesn't automatically make it a good investment. There are risks involved. It's crucial to do your homework and understand what you're buying into. Research the company's financials, market position, and growth potential. That's what we're going to explore together. How to make smart, informed decisions when those IPO invitations start showing up. Stay tuned as we dive deeper into the world of IPOs and uncover the strategies for successful investing. Before you even think about investing in an IPO, you need to understand the company's business model inside and out. What do they do? What do they sell? How do they position themselves in the market? How do they make their money? Is it through direct sales, subscriptions, or perhaps a combination of different revenue models? Next, dive into their revenue stream. Are they relying on a single product or service, or do they have multiple offerings? Multiple revenue streams can indicate a more stable business. Diversification is your friend here. It usually means less risk. A company with a diversified portfolio is often better equipped to handle market fluctuations. Finally, take a good hard look at their financial health. Check out their revenue growth, profit margins, and debt levels. Are they making money consistently over time? Are they drowning in debt? High debt levels can be a red flag, indicating potential financial instability. These are crucial questions to answer. They can make or break your investment decision. Understanding a company's financials can seem daunting, but there are plenty of resources available to help. Online courses, financial news, and expert analyses can provide valuable insights. Don't be afraid to ask questions and seek out information until you feel confident in your understanding. Consult with financial advisors if needed. Remember, knowledge is power, especially when it comes to investing your hard-earned money. The more informed you are, the better your investment decisions will be. Even if a company seems fantastic on paper, with impressive financials and a strong management team, it's crucial to consider the industry they operate in. The broader industry context can significantly impact a company's performance. Is it a growing market with lots of potential, or is it stagnant or even declining? Understanding the growth trajectory of the industry is essential. Think about the tech industry, for example. It's a prime example of a sector that's constantly evolving. With new trends and technologies emerging all the time, companies in this space must innovate to stay competitive. A company at the forefront of innovation in a booming market has a much higher chance of success than one stuck in a shrinking industry. The difference in potential can be stark. Look for industries with high barriers to entry, meaning it's difficult for new competitors to pop up and steal market share. This can provide a competitive edge. Also consider the regulatory environment. Are there strict rules that could impact the company's profitability? Regulations can either be a hurdle or a protective barrier. By taking the time to understand the industry landscape, including its growth potential, competitive dynamics, and regulatory environment, you'll gain valuable insights into a company's potential for growth and success. Every successful company needs strong leadership, and that starts with the promoters. These are the individuals or groups who founded the company and drove it to the point of going public. Do your research, look into their track record. Have they successfully launched and grown companies before? What's their reputation in the industry? Scrutinize their experience, their ethics, and their vision for the company's future. Are they passionate about what they do? Do they have a clear plan for growth? Remember, the promoters are the captains of the ship. You want to make sure they have the experience, integrity, and vision to navigate the often choppy waters of the business world. Section 5, The Price is Right, Understanding Company Valuation. Now let's talk numbers. One of the most critical aspects of evaluating an IPO is determining if the company is being valued appropriately. In simpler terms, are they asking for a fair price for a piece of their pie? This is where ratios like the price to earnings, PE ratio, and the price to sales, PS ratio, come into play. These metrics help you compare a company's valuation to others in the same industry. Don't just rely on a single number. Look at the company's growth prospects, profitability, and overall financial health to get a well-rounded picture of its true worth. Remember, even a great company can be a bad investment if the price is too high. Make sure you're comfortable with the valuation before you buy in. Section 6. The fine print, decoding the prospectus. Every IPO comes with a prospectus, a document that outlines the company's business, financial performance, management team, and potential risks. Think of it as the company's resume and risk disclosure form rolled into one. This document is your best friend. Don't let the legal jargon scare you. Take your time to carefully read and understand the key information it contains. Pay close attention to the risk factors section. This is where the company outlines everything that could potentially go wrong and negatively impact its business. Remember, knowledge is power, and the prospectus is your key to unlocking a deeper understanding of the company and its potential risks. Section 7. The popularity contest, gauging demand through subscription numbers. The subscription level of an IPO is like taking the temperature of investor interest. It tells you how many shares investors have applied for compared to how many are actually available. A heavily oversubscribed IPO, where demand far exceeds supply, can indicate strong investor confidence in the company. However, it can also lead to inflated prices. Keep in mind that high subscription numbers don't always guarantee future success. It's crucial to look beyond the hype and focus on the company's fundamentals. Think of it this way: just because a restaurant is packed doesn't automatically mean the food is good. It's essential to do your research and make your own informed decision. Section 8. IPO investing, a marathon, not a sprint. Investing in IPOs can be exciting, but it's crucial to approach it with caution and a long-term perspective. Don't get caught up in the hype or let your emotions drive your decisions. Remember, investing in a newly public company carries inherent risks. They haven't yet built a track record in the public markets, and their future performance can be uncertain. Take your time, do your homework, and only invest in companies that align with your financial goals and risk tolerance. Investing in IPOs can be a rewarding part of a diversified portfolio, but it's a marathon, not a sprint. Approach it with patience, diligence, and a healthy dose of skepticism, and you'll be well on your way to making smart investment decisions.